Thank you all for joining me today in this hearing to discuss how Wall Street reform will improve the lives of Minnesotans. Thank you especially to today's witnesses. Each of you will give testimony about the real-life impact of the economic crisis and on how the Wall Street reform bill addresses the problems that the crisis created. The failure of responsibility on Wall Street created this economic crisis. There should be no doubt about that. And that's why we have been fighting for meaningful reforms that will bring accountability to Wall Street, provide strong consumer protections, and end taxpayer bailouts. On May 20th, the Senate passed a Wall Street bill that brings us a step closer to finally changing the way Wall Street does business. The reforms will provide greater security to everyday Minnesotans, to families who are looking to take out their first home loan, to community bankers who've been playing by the rules all along, to small business owners trying to stay afloat, and to retirees who want their pensions to be secure. Over the last year, Wall Street has repeatedly tried to smother our reform effort with expensive lobbyists and expensive ads, and after they were unsuccessful, they tried to poke holes in it, creating carve-outs and deals for special interests. But the bill that ultimately passed the Senate was a strong one, and I thought actually once we finally got it being debated, it got stronger, and sometimes in a very bipartisan way, and it's one that I'm proud to have supported. The bill includes a provision that I introduced as an amendment to the bill, to the reform, to reform the credit rating industry. The credit raters are companies that evaluate the risk of different securities, and they decide if they're AAA or junk or somewhere in between. The problem is that the banks that issue the securities, the way it's been an issuer pays model, and basically the issuer shops around for the credit rating agency that's going to give them the best rating, and it's in the credit rating agency's best interest to give an inflated rating, because if you give a AAA rating, then to one security, then you'll get hired again for the next one. So this incentivizes inflated ratings instead of accurate ratings, and that's exactly what happened. And my bill basically creates a independent third party to assign the ratings. And it'll be under the SEC. It'll be a board, a self-regulating organization comprised, a majority of whom will be investors, people who are managers of pensions, managers of university endowments, those kind of things. There will be someone from the credit rating agencies represented in the board. There will be someone from the banks in the board. There will be someone independent, but the majority will be investors. And they will assign the initial rating of any asset-backed security that an issuer presents. It will be assigned by a third disinterested party, eliminating the conflict of interest and rewarding accuracy, and it'll break the oligopoly of Standard & Poor's and Moody's and Fitch, who did 94% of the ratings. And it'll open it up to the smaller rating agencies, and again, the ones that are the most accurate will be rewarded instead of the ones who are inflating the ratings. So that way, when a pension fund manager buys a AAA rated bond, it'll actually be AAA rated. The bill, the whole bill will also bring transparency and accountability to the kind of complex derivatives deals that help trigger the financial crisis, and it takes taxpayers, this is very important, takes taxpayers off the hook when the big banks fail. The legislation has wind downs for these banks, and the banks have to periodically, and these financial institutions have to periodically submit plans to wind themselves down if they get in trouble. The bill benefits consumers by eliminating kickbacks to mortgage leaders who get paid bonuses to lure homeowners into expensive subprime mortgages, even when they qualified for non-subprime mortgages, for prime mortgages. It also provides one free credit score per year to any consumer who requests one. It helps small businesses by ensuring that the swipe fees paid for debit card transactions are based on the cost of the transaction, not set at an arbitrarily high rate, and this will help retailers, small businesses. It's very important. We're going to have a witness later to talk, to speak to from that perspective of a small business. Overall, this bill strengthens the stability of our financial system, which in turn will ensure that our economy never comes crashing down again, wreaking havoc on American families. I want to again thank each of our today's witnesses who, like every Minnesotan, has a personal stake in ensuring that our financial system is stable and secure. So I'd like now to have the panel just briefly introduce yourselves. Our first panel, we have Dan Williams, who's, and I'll let Dan introduce himself, and Todd Stevens, a general contractor, and Ron Elwood, staff attorney for Legal Services Advocacy Project. Why don't we have Dan go first and tell us a little bit about yourself, and today give us about, what do we ask for, about 3-4 minutes, something like that?
Okay, I'm Dan Williams. I'm Program Director for Lutheran Social Service of Minnesota Financial Counseling, and we'd be the largest community-based nonprofit financial counseling organization in the state of Minnesota. We do both financial counseling, credit counseling, as well as foreclosure prevention work. And I just want to talk a little bit today about sort of the struggles of the families that we see around Minnesota. And I think what's fair to say is that lots of our neighbors are hurting, really hurting. LSS Financial Counseling has been around since 1987, and the demand for financial counseling and credit counseling and so on was fairly stable up until around 2004. We were meeting with about 5,000 Minnesota families a year. In 2010, we'll likely meet with over 20,000. So a quintupling of demand for financial advice, financial guidance for people that are really struggling. You know, what I want to talk today is about how the families that we're meeting with, I like to refer to them as sort of that middle 60%. So often the families that we're meeting with are working families, you know, making somewhere between, you know, $15,000 and $70,000 a year. Those families often, when the economy was really thriving, when unemployment rate was low, when the stock market was going up, they weren't taking advantage of it, or weren't in a position to take advantage of it, so they didn't ride the wave up. They often, you know, purchased their homes relatively recently, so they didn't capitalize or weren't able to capitalize on rising real estate values. Often were just in a position of their budgets making ends meet, and so they didn't have lots of money in retirement savings when the stock market was going up. And so, you know, the families that we're meeting with are suffering the consequences from the economy sort of falling apart after the unregulated housing market, the unregulated Wall Street systems. And so what's happening now, unfortunately, is that just like the people that we're meeting with often didn't capitalize on the rising market, you know, over the last 10 years, they're often exactly being taken advantage of by players in the market right now. So payday lenders, debt settlement industry, foreclosure rescue scams, that sort of thing. And so an entire industry is really strung up to started up to take advantage of people that are struggling in today's economy. Last August 26th, as a matter of fact, Senator Franken was kind enough to join us to a recognition event for our foreclosure prevention staff. And I remember very well talking about the numbers of people that each one of our counseling staff had met with over that previous 8 months or so. And it was quite staggering, several hundred, 500, 600 families, individual counselors had met with. And we sort of did that recognition event as sort of an effort to thank our staff for getting us through the peak of the foreclosure crisis. And unfortunately, what's happened is in the 8 months since that event, we've actually seen more demand for foreclosure prevention counseling than in the 8 months prior to that event. And I think that really speaks to what the economy is doing to average Minnesotans, average Minnesota homeowners around the state. The people that we're seeing right now, or many of the people we're seeing right now that are facing financial struggle, whether that be credit card debt or medical debt, foreclosure, are taking home $2,000, $2,500 a month, which might not seem bad unless you talk to those families and see that 2, 3, 5 years ago they were making $40,000 or $50,000 or $60,000 in their household. And so a family that was just making ends meet, making $50,000 a year in their household with a couple of incomes or so on, really just cannot make a go of it at $20,000 or $25,000. So that's really what I want you to take from this, is that a lot of the people that we're meeting with are having to decide between needs. It's not, should I buy a boat or should I buy a motorcycle? It's, should I pay my debts back or should I pay my mortgage payment? And so that's what I hope you take from today's testimony.
Thank you very much, Dan. I have some questions for you, but we'll go through all the witnesses, and I'd like to turn now to Todd.
Thank you. I guess listening to him, I do fall right into that category, what he was explaining. I'm a 49-year-old carpenter contractor. I've been married for 26 years. I have 5 kids. I was also a volunteer firefighter on the Mission Fire Department for 23 years, and I handled the Relief Association pension funds. So I have a basic understanding, not in depth, of how pension funds work and how we try to build those. That was my job, and we actually ranked in the top 5% of the state in our investing. I've been doing construction in the Brainerd and Cross Lake area for approximately 26 years, and I did not work on Denny Hecker's house.
Too bad.
Yeah. 4 years ago, my then 14-year-old daughter was diagnosed with ovarian cancer. After several surgeries and chemotherapy at the Mayo Clinic, we spent quite a bit of time in Rochester. It's a lovely town. She has been cancer-free for 3 years now, doing very well. And I mention this because it was basically the start of my own financial tailspin. I was operating debt-free in my business until then. I own the cars that I drive, and I own my own tools. I was responsible with my credit cards. I had only a home equity loan on my house. Home equity line of credit. Typically, I could dig out of the setbacks like this in the construction industry. We go back and forth, some good jobs, some bad. I'm able to generally dig out from that. But the following year, after the cancer situation, I had a couple of jobs that didn't go well. My expenses were going up, and money was starting to get tight. The last new house that I built was 2 years ago for a retired college professor and his wife. This was going to be his dream retirement home on the lake, up by Pequot Lakes. He had the funds available, was set to go, but by the end of the 6 months project, the stock market had pretty well crashed, and he had lost much of his retirement fund value. To finish the project, he had to take money out of his IRA at a realized loss of well over 60% from the beginning of the project. The appraised value of the new house was less than the cost that it took to build the house. So financing was getting hard to secure. After many discussions about options with the homeowner, we agreed to split the losses with him, and he was able to keep his house. Needless to say, I didn't make a profit, but I do sleep well at night. I want to be clear on this, that I am the do the right thing kind of person. I know there's others out there that don't. But when I finish a project, the homeowners are happy with the work that I did, and I will make a fair wage for the work that I do. And I expect to be friends with the people that I work with and I work for. I will walk away being their friend. They aren't just clients to me. I end up being friends with them. All my work for the past 10 years has been word of mouth. I don't advertise, which good, bad, indifferent, I'm not going to say. We have always tried to live within our means, but in 2009, I had the worst year in 26 years of doing construction. I grossed $13,000, just a little over $13,000. My expenses for that year, which are including my license, my contracting stuff, insurance, I had expenses of about $7,500. That means I only netted $5,600 last year. I sold my toys, you know, the typical thing. I had a travel trailer, four-wheeler, spare car. I've sold a bunch of tools. My wife picked up a temporary job, but we still can't, we couldn't make the business debt payments, which now total approximately $70,000. In March, I believe it was March, I contacted, me and my wife contracted Lutheran Social Services in Brainerd for some financial counseling. We got some very good advice from them on different things. The money that I have been making so far, we've been making our budget work. I mean, we're making the payments, except for my business debt. That was the one thing that we concluded, is stop using my personal assets to pay for business debt. I was basically digging myself into a hole by using my personal assets to pay for it. The biggest business debt that we've been dealing with has been the Wells Fargo Bank. We've had a lot of loans from them. I talked to Wells Fargo in November last year, 2009, and asked them for help, stating that I couldn't continue making payments on the line of credit. And I asked them if they had any programs that could help me out, and they said, no, we don't have any programs to help you out at all. And that if I didn't make the payments, that I would have to make double payments, and the interest would go higher. I'm right now at 17.25%, between there and 27.24% interest on my 3 loans that I've got with Wells Fargo. Right now, I'm getting an average of 12 phone calls a day from the Wells Fargo Bank people. I get 4 on my cell phone, 4 on my wife's phone, and at least 4, maybe more, on my home phone. So they're just every day. Weekends, holidays included, Easter, you name it. I'm thinking people take a break. My financial advisor from Lutheran Social Services said they will not deal with you until you are at least 3 months behind on payments. So we're about that right now, and I'm not sure where I'm going to go with it yet. I used to have a safety net. My parents used to own a resort, and they sold that, you know, off as an association years ago, and I could use them as a safety net. You know, if I really needed some funds to help make payments, I could get it from them. But they lost, I think I talked to them, approximately 40 to 45% in the stock market in their retirement fund setup. So I don't have that safety net anymore. At this time, like right now, I do have work available, and I can maintain my personal responsibilities. I can make the payments that I need to, except for my business. But I can't recover from this economic downturn and carry my debt load right now. It's going to take years to come out of it. I've considered filing bankruptcy. At this point right now, I can't afford the $2,000 that the attorney wants to file the papers. He wants it up front. So, and I'm not sure that's the answer. I'm holding off as long as I can. I don't want to file bankruptcy because I've always paid all of my debts. I don't feel it's anybody else's responsibility to pay my debts but me. I have considered moving to a more business-friendly state that has fewer restrictions and less red tape. I've got some friends right now in North Dakota want me to come out there in the worst way. He says, we'll double your income what you were making the years before. So it's an option. I haven't ruled it out. I've lived here all my life. But it's an option. We're looking into it. One thing, like I said, I'm not the, I haven't said that, but I guess I'm not the sucked-up-to-the-government-hog type of person. I will not, I don't want to ask for help. You know what I mean? I know a lot of independent contractors that are in the same boat I am. The plumber that I contract with, his name's not Joe, it's Tim. He's in the same boat. He's going to lose his house. He can't recover from where he's at. I guess that's I'm not sure what to ask for, but that's my situation. That's where I'm at.
Thank you, Todd. We'll go next to Ron Elwood.
Thank you, Senator. Thank you for the honor and the opportunity to testify before you today. I really want to commend you, Senator Franken, for the courage that you have shown and the other members of the Senate in the face of great pressure to maintain your unwavering support for consumers and for the Restoring American Financial Stability Act. My primary role as a legal aid attorney is to conduct state and federal legislative advocacy, and in that role, I've had a front row seat as a witness to the devastating results on families and the economy wrought by the financial meltdown. In my limited time today, I'd like to focus on just a few of the many ways in which this bill will provide protections and benefits for Minnesota consumers. First, very importantly, it bans loans, mortgage loans, unless the lender can verify the borrower's ability to repay the loan. Critical. Second, it creates a Bureau of Consumer Financial Protection and charges that Bureau with the vital rulemaking power to fulfill one of its most important and primary duties, which is to protect consumers from, and I quote from the bill, unfair, deceptive, or abusive acts and practices, and from discrimination. Third, it establishes the Office of Fair Lending and Equal Opportunity within the Bureau and charges it with improving access to fair and affordable credit for traditionally underserved communities. And I can't commend you enough for establishing such an office and addressing those issues of disparity. And fourth, it sets up a financial victims compensation fund to ensure that when perpetrators are long gone, victims still may have hope of relief. Fifth, it creates an Office of Financial Literacy within the Bureau to help consumers understand the Byzantine financial system and its frequently confusing offers, contracts, and products. The importance of this function just cannot be overstated. And finally, it establishes an Office of Financial Research to develop risk assessment tools and charges the Bureau and the office with researching, analyzing, and reporting on market developments to act as an early warning system. The canary in the coal mine function that this office will provide is essential if we're going to head off future crises like this one. So let me just offer one concrete example of a client that came to legal aid who might have avoided a tragic fate had this law been in place when the predators came to his door. Our client was a 70-year-old African-American man suffering from a mental disability who achieved only a second-grade education. You know where this is going.
Yeah.
The only thing his parents left him was their house, which they owned free and clear. Between 2002 and 2007, he was preyed upon by an unscrupulous broker who convinced him to refinance his house 4 times, telling him he didn't need to read the documents or get anyone to help him understand them. His last loan was an option arm that escalated to a payment far beyond his ability to pay. And I have been privileged in my work to work with people like Dan and Professor Prentice Cox, Michelle Kimball, who you'll hear from later, and others in passing landmark consumer legislation here in Minnesota. For example, the predatory lending law, the Minnesota law, that forms the basis for some of the provisions in this bill, and the Debt Settlement Act, which Dan was very helpful on, that now serves as a national model. Regulation of the financial industry does not eliminate consumer choice. Rather, it levels the playing field to ensure marketplace fairness. I'm confident that when this bill goes to the President, it will provide the appropriate regulatory structure to both predict and react to toxic financial schemes that in the past have permitted the proliferation of questionable financial products designed to generate profitable commissions, excessive fees, and untold wealth for the lenders, while placing unfair and undue risk on borrowers, destroying families, and crippling our economy. In closing, I'd just like to relate an excerpt from the retirement speech given on the floor of the Minnesota Senate just 2 weeks ago by Senator Steve Dill, a Republican from Dassel, Minnesota. I think it serves as a fitting conclusion to this testimony. Senator Dill observed that we have the luxury of freedom in America, not in spite of regulation, but because of it. And so thank you, Senator Franken, for the opportunity to testify today. Your efforts to protect Minnesota consumers, including the amendment you achieved that eliminates the conflict of interests for the credit rating agencies, and your staunch support of financial reform will provide immeasurable benefits for Minnesota consumers for years to come. Thank you.
Thank you. Thanks to all of you, especially you, Todd. You know, I'm struck with some of the rhetoric I've heard about people who've been affected by this financial crisis, and especially people who find themselves headed into foreclosure. And Dan, you talked about the middle 60%, the people who, on the way up, weren't able to take advantage of the way up, but are paying the price for everything on the way down. And you very often hear, oh, I don't want to help people who speculated, and you know, and it seems like Todd's story is not atypical. Here you have someone who was doing everything right, exemplary craftsman, an exemplary businessman in terms of ethics, an exemplary family man, and yet he got dragged down by this meltdown. This meltdown that was caused by a whole different array of misconduct that that we're hoping to prevent again. So what I want to ask you is that sometimes you hear about these that there are people who speculated on homes, and that's you know, when we're trying to take care of people who are being foreclosed upon, that we shouldn't be rewarding those people. There are obviously some folks who did that, but that's not the typical person that you deal with, is it?
No, I would say we do get calls from people that, you know, are investors and own multiple properties and are now facing foreclosure on often all of them. I would guess it's less than 5%, probably less than 3% of the people that contact us about foreclosure prevention. By and large, the people that are contacting us about foreclosure prevention start off with one phrase, almost exclusively, I never thought anything like this would happen to me. The people that we talk to that are facing foreclosure often picture themselves retiring at age 60 to a comfortable retirement where they could help out their kids and help out their communities and volunteer. And now they're in a situation where they don't know if they're going to be able to retire. You know, the people that we're talking to that are facing foreclosure by and large own modest homes, have modest incomes, have been responsible, you know, community members.
And Todd strikes me as typical, more actually more exemplary than maybe typical. But I mean, but typical in this sense is that I know that a lot of people who have gotten in trouble have had health care bills, and as you know, in so many ways in which Todd's story is so awful, there's one aspect of this, which is that your daughter's been cancer-free for 3 years. And I think that's just wonderful.
Thank you.
But there are the people who are tending to run into either foreclosure or bankruptcy are not people who had done something like speculated on homes. They're people, by and large, who've had a health care crisis, like Todd had, which dwindled your resources, and then had a loss of job or a job where the bottom fell out of what the income is. I mean, this is what Todd's story is. Todd, you actually managed the pension, did manage the pension for the volunteer fire department, is that correct?
Yeah, we worked closely with, I believe it was Merrill Lynch that did our actual investments, but we directed him to invest.
I'm just curious about that because we're going to have a witness later who is the fire chief. And most firefighters in the state are volunteer. Mm-hmm. And their payment basically is a pension, right?
Right. And we're lump sum pension, $1,500 a year per year of service.
And what happened to the pension fund?
It lost a considerable amount, but I wasn't in the management part of it anymore.
Right.
Since I'm basically retired now.
But this happened to so many. This happened to so many. So many pensions, and it happened to so many pensions not because of the meltdown. The meltdown basically took the value of every stock down, and it wasn't about necessarily having a AAA rated security that turned to junk. It was those AAA rated securities that turned to junk created the meltdown. Well, I want to thank you all. We do have 3 panels, so I'm going to move on. But I want to thank you. And Todd, I hope you stay in Minnesota, just for our sake. But if you got to go to North Dakota, I suppose you got to go to North Dakota. But I'd rather you stay here because I can't tell you how much I admire. You're what Minnesotans are about. You seem, you are an exemplary businessman, an exemplary family man, an exemplary citizen, and this just shows that how this financial crisis affected people who were doing everything right. And I want to thank you, all 3 of you. Thank you.
Thank you.
Okay, so let's get panel number 2 in here. And we have Prentice Cox and Debbie Hart. Debbie, why don't you go ahead and tell us
Thank you.
what you do.
Senator.
Yeah.
My name is Debbie Hart. I have a small retail business in downtown Excelsior selling art supplies and picture framing. I've been there for 32 years. I've seen a lot of changes in
Could
how
you
we-
speak up just a little bit and maybe a little closer to the mic?
Okay. Is that better?
Yeah.
Okay. I've been in Excelsior for 32 years with my retail store, and I've seen a lot of changes over the years in how we take credit cards and how our customers pay for their goods. Years ago, almost every transaction was with check or cash. These days, it's all with plastic and very little cash and check. It used to be pretty straightforward. The credit cards, we'd pay a small percentage of the transaction and a swipe fee to accept the cards. Over the years, it's changed, and there's several different types of fees that they will charge you. In addition, they've put different levels on the different types of credit cards. Your debit cards, reward cards, your business cards, you all pay a higher fee to have those types of cards. If it's okay with you, I'll continue on reading from something I prepared.
Sure.
I was actually kind of just made aware of the details of the bill last week. When I was at my local bank, I was given a form addressed to its customers, all made out with postcards to send in to my senators.
To me.
Yep.
Okay. I didn't get it from you.
I'm not going to send, I've got a new one for you. The letter was asking the consumer to fight the interchange legislation bill, as it wasn't fair for the consumer to pay for the retailer's cost of doing business. It went on to say that retailers sell more, reduce their costs, and increase profits, all because we accept credit and debit cards. Well, that couldn't be further from the truth. The truth is, because we take debit and credit cards, we have higher costs and reduced profits. Nor do I see customers buying more because they are using a debit card. The fact is that the fees we're paying keep going up and up. It'll cost me anywhere from several $100s as much as $1,000 a month just to accept cards, while it doesn't cost me anything to take checks and cash. Then there's the reward cards. Well, I pay double the fees on those transactions. These days, most consumers are either using business cards or rewards cards, and it is the retailer who is paying for their rewards. If you add the percent of the sale fee or interchange fee to the batch fee and the statement fee, and add that to the 15 or 20 cents you pay per every time you swipe a card fee, it really adds up. This year they added a new fee, the PCI compliance fee. Besides the fees they charge, they also get interest on my money as it sits in their bank before they release the funds to me. Sometimes a processor will offer me a better deal to send my business their way. I'm always shopping around to save money. If they can save me $50 or $100 a month, it helps. However, it can be quite an ordeal to change processors. You really have to pay attention to their contracts. Several pages long with print that you can only read with a magnifying glass, and then hire a lawyer to help you comprehend it. It's not uncommon. The bank says that they assume all the risk and loss and guarantee payment to the retailer, but the contracts read otherwise. They can and have held our money for as much as 30 days for whatever reason they feel is justified. It's all in the contracts. I do not feel that it's fair to put so much of the burden on the retailer. It is the issuing card bank that ends up with the most to lose if this bill passes, and it should. After all, it is their card and their bottom line. Shouldn't they be responsible for their cost of doing business? Why do they expect us to cover their cost of doing business? The past 2 years have been especially hard on many small businesses. I've seen many shops close their doors. If this bill passes, not only will it help keep soaring debit card fees in check, but it will also give us some say as to how we accept cards by allowing us to establish minimum transaction amounts or offering discounts on other less expensive forms of payment. Small Main Street businesses are the backbone of this country. We need your help in keeping the big guys from nickel and diming us to death. Last evening, I attended our Excelsior Downtown Business Group's monthly meeting, and I prepared a petition supporting this bill, and I do believe that everyone in attendance signed it, and I'd like to give that to you. Thank you so much for listening to me.
Thank you, Ms. Hart. Professor Cox?
Thank you, Senator. My name is Prentice Cox. I'm a professor of clinical law at the University of Minnesota Law School. Before that, I ran the Consumer Protection Division and was Assistant Attorney General at the Minnesota Attorney General's Office. In that capacity, I did work with Denny Hecker, unlike Todd. I want to thank you for the opportunity to participate in this forum at really an extraordinary moment in our history. The market for financial services, and this is a really important point that I try to make everywhere I talk, was a disaster before it was a financial crisis. It was a disaster for homeowners, it was a disaster for consumers, and it caused tremendous damage before everyone paid attention because the markets collapsed. The collapse of the market and the subsequent collapse of the economy as a result of these problems simply magnified the concerns that were there before. Following the Great Depression, we erected a strong regulatory system that worked for several decades. It allowed reasonable access to home mortgage funding and credit. The U.S. government insured deposits and supervised prudent lending, and it was boring and it worked. Starting in the 1980s, we began to implode all the controls we had over the financial market. By the 2000s, lending in residential mortgages and in many other areas were controlled by a non-banking financial institution sector that was completely unregulated for the most part, including the credit rating agencies that you've worked with to control. Meanwhile, federal banking regulators in the regulated segment of the economy became thoroughly identified with the short-term interests of financial institutions, not the needs of average Americans. I had a situation in 2000 where I led a delegation of, 2002, where I led a delegation of assistant attorney generals to meet with the OCC, the primary banking regulator, to try to work on an area of common concern. Not only did they basically say, we are not interested in working with you, they lectured us about preemption and then proceeded to file an amicus brief on behalf of the bank that we were suing, Fleet Mortgage Company, which had surveyed its own customer service reps, and they had said things like, this is a fraud, this is a scam. And the OCC intervened on behalf of the mortgage system rather than us. They became thoroughly identified with banking and hostile, not only just indifferent, but hostile to consumer protection concerns. The Restoring American Financial Stability Act is really a remarkable act. It's incredible in its breadth, and it's done an amazing job of addressing a wide range of areas that needed to reinstitute the regulation that made our financial system work for approximately 3 generations following the Great Depression. In addition to creating, for the first time, a true consumer protection agency in one place, it creates systems critically needed for derivatives, failing financial institutions, and credit rating agencies. My colleague Claire Hill accosted me in the hall the other day and said, I wrote this article for the New York Times deal book about Franken's amendment on credit rating agencies, and that's the one that's really going to work. That's the right amendment. Now, I understand the Wall Street
Smart.
Yeah, she's like a superstar on these issues. For many years, she's written on credit rating agencies before the collapse, and it was very complimentary of that work. I told her I would come here and pass that on to you.
Thank you.
I understand the Wall Street Journal has criticized you on this, which is yet another sign that it's an excellent piece of legislation. The reach of the act is extraordinary, as Debbie testified, even helping out small retailers and a system that was, once again, highly unbalanced in favor of financial institutions. This law is substantially about using the power of smart regulation to create fairness in a marketplace that has been lopsided in rewarding a bloated financial sector. Finally, this bill reminds me just to mention Paul Wellstone, because Paul Wellstone would have loved this fight. Paul Wellstone understood that arcane issues like this really make a difference in people's lives, that the way we live is to a large extent determined by these kinds of small decisions that affect our pocketbooks from angles that we don't really understand. And he made those issues relevant to people's lives and articulated it very well. And I think we're very lucky in Minnesota to have a senator who carries on that tradition for us.
Well, thank you for your kind words, and I will say it was the Wall Street Journal editorial page
Ooh, even better.
that went after me on this, not the, of course, and I wear that as a badge of honor. Let me make sure that I get to both of you here. Ms. Hard, can you just explain, for example, on the debit card? I mean, we were talking, that's really what we're talking about here on the interchange fee. And I actually got lobbied by, I think, the bank that we went to. It really doesn't cost the bank anything when the debit card is swiped, does it? Can you explain that?
No, the debit card is an automatic withdrawal out of their account. The funds are there.
Right.
They're not putting up the money like they do with a credit card.
Exactly. So, but they were charging as much for?
Yeah. Yes, they are. In fact, sometimes more. It used to be when the debit cards first came out, we weren't paying anything additional. In fact, we were paying 0% in the beginning, and it's just slowly crept up and gotten higher.
Okay, and what did they say on that thing, that you were going to pass this on to the consumer and take their money and to make yourself rich?
That's kind of the gist of it. It really pitted us against the consumer, and I guess that's how he's picking the fight. But it's not us versus the consumer. I really feel it's the bank's responsibility.
So basically, the banks, and they just wanted this money, and you're a small business, and it could either go to the bank, or it could go to the retailer, or to the customer, or the retailer and the customer could kind of split it up, or it could go to the bank, right?
Right.
Now, did the person who gave you that thing at the bank, they weren't instructed, don't give this to retailers, or they just didn't know you were a retailer?
I'm not sure. It's funny, I went back to get some extra copies, and they all disappeared, and I think they knew who I was then.
Professor, sometimes I hear that, oh, this has gone too far, this bill. Do you have any opinion on that? I mean, when you say that things started to unravel in the 80s, it was certainly on consumer protection. But I know that when Glass-Steagall was sort of broken down, it made banks, it allowed investment banks to do other kinds of things that it was doing, and allowed banks to do other things, and it allowed non-banks to do lending and that kind of thing. Do you think we've gone far enough in this thing?
No, I think this is probably, after the Great Depression, it actually took about 10 years to get in place the regulatory system that then worked for several generations. But this is a really wonderful, I consider it a first step. And just to give you an example of how we haven't gone far enough, as if cynics about government capture by financial services industry needed more ammunition, the House bill exempts auto dealers, title insurance and related insurance, credit insurance, and private student financial loans. And if you ask for 3 of the top 10 areas that are perennially on the top list of consumer complaints, those are 3 of them.
And I hope in conference those go, but well, listen, I have to go to the next panel, but thank you very much. And Ms. Hart, I look forward to going out to Excelsior and checking your place out.
Thank you, sir.
Thank you both. Okay, next we have Michelle Kimball, Minnesota AARP State Director, and David Berg, and Fire Chief George S. Benson from the Minnesota State Fire Chiefs Association. I think most of you can tell which one the fire chief is and which one Michelle is, and then by process of elimination we know which one David is. Michelle?
Thank you,
I'm
Senator.
sorry, Ms. Kimball. Yeah.
Thank you. I'm Michelle Kimball. I'm the Senior State Director for AARP here in Minnesota, and I represent nearly 700,000 consumers over the age of 50. I want to thank you for the opportunity to appear before you today to talk about this really very important issue, not only for our members, but for all older Americans, especially here in Minnesota. AARP is pleased that the Senate passed the Restoring Americans Financial Stability Act to help create a more level playing field for consumers and investors as they navigate the financial marketplace. Reckless behavior by big banks, mortgage lenders, and credit card companies have cost millions of older Americans their jobs, their retirement savings, and their financial well-being. Americans, whether they're Republicans, Democrats, or independents, want Congress to hold the financial industry accountable. Older Minnesotans have millions of dollars in retirement savings in the financial system, and they deserve transparency and accountability in Wall Street. The retirement security of Americans may be one of the greatest casualties of the financial crisis. The financial meltdown that this country experienced wiped out an estimated $2 billion or $2 trillion in the retirement savings of Americans in just 15 months. The dwindling of these assets, about a 20% decline overall, comes at a time when many people, including seniors, are grappling with more credit card debt, declining home values, and reduced access to loans. At the same time, while older households long have been considered among the most frugal and resistant to consumer debt, changing economic conditions, particularly declining pension and investment income and rising costs for basic expenses, such as prescription drugs and health care in particular, have forced many seniors to rely increasingly on credit to make ends meet. At the same time, research suggests that older Americans consistently borrow at higher rates and pay more fees for various financial products, including home equity loans, auto loans, credit cards, and mortgages. Growing numbers of seniors also have been impacted by abusive payday loans and bank overdraft fees. The Restoring American Financial Stability Act does take positive steps toward restoring accountability and responsibility in the financial markets. The legislation recognizes the important role that consumers and investor protection play in ensuring not only the fairness, but also the stability of the financial markets by creating a new Bureau of Consumer Financial Protection and giving the Security and Exchange Commission important additional authority, funding, and direction to protect investors. Too often, as you may know, older Minnesotans fall victim to financial crimes and schemes that wreak havoc on their retirement security. We are very pleased that the legislation establishes a consumer watchdog that will develop and enforce rules to help protect all Americans from financial predators. Today, there are 7 federal agencies that all have some responsibility to protect consumers. It's a bureaucratic model that has really failed Americans. This is why AARP has urged for the creation of one consumer financial protection agency and has its sole mission in protecting consumers from deceptive and abusive financial practices. We believe that Americans deserve one independent and effective regulator that will focus exclusively on preventing abusive and deceptive practices that cost these hardworking Americans their savings, investments, and oftentimes, and in more growing situations, their homes. We have actually worked hard to prevent the financial industry from selling products that customers cannot afford or may not meet their needs. To this end, the bill requires banks to clearly disclose the terms and conditions of loans and credit cards in plain language so that we can all read and understand the terms. And Senator Franken, AARP would actually like to thank you for your work to improve the legislation by authoring the amendment that you did to reduce the conflicts of interest. Between Wall Street and credit rating agencies, these conflicts of interest have obviously cost Americans, especially seniors, too much. It is painfully clear that the failure of the existing regulatory system to rein in abusive types of consumer loans in areas where federal regulators had clear authority to act and either chose not to do so or acted too late to stem serious problems in the credit markets can no longer be tolerated. AARP recently commissioned a nationwide survey revealing that support for the reform that is in this bill has very high support across political party lines. For example, almost all respondents, 96%, favor requiring banks to explain the terms and conditions of loans. Support is consistent across all political parties. In addition, more than 9 in 10 favor requiring companies that manage 401k retirement plans to explain the fees that they charge to participants and to clearly state those fees on participants' annual statements. 92% favor requiring investment companies to disclose the costs, the risks, and the benefits of all the financial products they market, and to do so in plain English. Almost 9 in 10 favor protecting people from predatory lending practices, such as excessive fees and penalties on products ranging from mortgages to credit cards. In conclusion, AARP believes this legislation will protect thousands of real Minnesotans who are still in the midst of trying to recover from the financial crisis and from further damage. I am pleased actually to be joined today by an AARP member and volunteer, Dave Berg from Eden Prairie. Dave is with me today to share his personal situation, which will illustrate just why this reform is so needed. Minnesotans like Dave deserve to know that the financial institutions are being held accountable and that abuse in the markets will not be tolerated. AARP looks forward to seeing this consumer protection legislation enacted into law, and we again thank you, Senator Franken, for your leadership on this important issue. I will be happy to answer any questions you have.
Thank you, Ms. Kimball. Mr. Berg.
Good morning. Thank you for listening to me. I'm Dave Berg of Eden Prairie, and I appreciate the opportunity to share my story with you. My situation mirrors the situation of thousands of Minnesotans in my age group and my occupational status, and illustrates why it is so important to reform the way Wall Street operates. I'm 57 years old and looking for work. Having spent most of my career in the IT field, I've been out of work for about 14 months. I worked for a Fortune 500 company full-time until our entire department was eliminated. The jobs were outsourced to India. Throughout my working career, I saved for retirement. I participated in pension and 401k plans that my former employers also contributed to. I thought I would have a secure retirement because I thought I was doing the right thing. My safety net grew through the 90s. Like most Americans, I watched my retirement accounts plummet through the 2000s, as well as the latest financial crisis. While some of that nest egg has now started to grow somewhat in the last year, much of my overall retirement security is gone. That means not only am I looking for a job to pay the bills, I'm also looking at the prospect of starting over when it comes to saving for retirement. At the age of 57, I need to start building up a nest egg so I can hopefully afford to retire in my 70s. Eventually would be a better word. This was not my plan. While I have always considered my pension and 401ks my last resort money, I'm now faced with the prospect of needing to use that account to pay the bills. As a job seeker in my 50s, I'm not alone. Thousands of trained professionals in my age bracket are currently looking for work, and we know that our job search will be longer and harder than that of a younger worker. Twice weekly, I meet with groups of job seekers, many of whom are in the same situation as I am. While we keep our outlook positive, most of us are faced with the prospect of starting over, and we are resigned to the fact that we could be working into our 70s. The downturn of the economy, caused in part by the abuses of Wall Street, led to the loss of my retirement security. Reforming the way Wall Street operates is important to me personally because I still have a lot of saving to do, yet I cannot afford another Wall Street meltdown. I need to have confidence in the markets, and I need to know there's accountability to those who caused this financial crisis. Through AARP, I was recently trained as a fraud fighter volunteer. Our role is to help older Minnesotans avoid becoming victims of financial frauds and schemes. Older consumers are targeted by crooks, and unfortunately, too many elderly or vulnerable fall victim to investment fraud, charity schemes, identity theft, or Medicare fraud. These crimes have increased during the economic downturn because so many Americans are looking for their break, and fraudsters are preying on the vulnerability that we all feel in this economy. More must be done to protect consumers from the scams that take away their retirement security. I know that I'm luckier than many who suffer through this financial crisis. I have loved ones who are helping me through this time, and luckily I did not fall prey to a Ponzi scheme or a Madoff scandal, and I have no money invested vested in British Petroleum. So I appreciate that the U.S. Senate has now taken a first step to crack down on abuses by Wall Street. But please know there is more that can be done. People like me are still suffering from the economic downturn, and we are fully aware every day how slow this recovery actually is. Senator Franken, thank you again for holding this hearing to bring attention to the issue, and thanks for the opportunity to speak today.
Thank you. Thank you, Mr. Berg. Mr. Fire Chief.
Thank you, Senator. Thank you for conducting this hearing. My name is George Espenson. I'm the Fire Chief for the City of Eden Prairie, and I'm here today representing the State Fire Chiefs Association. And I just wanted to talk very briefly about how the economic downturn and the crash on Wall Street has affected really citizen volunteers who make up about 90% of our firefighting force in the state of Minnesota are volunteers at some level. Some do receive some sort of modest hourly pay or call pay, and a lot of them do count on a modest pension to be their reward for years of service, like one of our previous testifiers in the Brainerd area. The examples I'll give you are several. The first one is the one I know most deeply, which is Eden Prairie Fire Department. Before I was fire chief, I was also president of our Relief Association, like our previous testifier, and so understand a little bit about how that works. In 2008, our fund took about a 28% decline because of the situation on Wall Street, running down from about $16 million in assets, one of the highest funded plans in the state of Minnesota, down to just over $11 million. And one of the problems that you run into when you suffer that kind of a decline is that there's an audit function that takes place every year out of the Minnesota State Auditor's Office, and you have to recapture those declines amortized over 10 years. And so what that meant was our normal city contribution of just slightly over $700,000 rose to $1.4 million. And of course, then that is just right on into the teeth of a market collapse with tax revenue collection and how that all impacts people, and people are out of work. Like the gentleman to my right here, and so nobody really wants to hear that news, but promises have been made to firefighters about what their future pension's going to look like. So very significant. And you wind up also running the situation where math kind of works against you, where in simplistic terms, if you have a 50% decline in your asset base, then in order to make that back, you need a 100% return rate, because you've gone from, 16 million down to 8. In order to get back to 16, you have to double your return. So it's not just that you need in our case, a 28% return in the market. You really need about a 43% return in the market in order to make back going from 16 down to 11. And so that really, compounding is working against you in that case, I guess is the easiest way to describe it. Another example, I'll give you several, is Cambridge Fire Department. Because of what happened in 2008, early in 2009, it's my understanding their council made a decision to roll back their lump sum benefit effective early in 2009. And as a result of that, in order to protect their pension benefits, 9 of their most senior firefighters retired, taking with them about 200 years of firefighting service, and most of their senior command staff left in order to protect their pension in order to retire before the rollbacks took place. Osakis lost about the same amount that Cambridge did, and Wilmer lost 13 people, and again, over 250 years of service, all for those same reasons. Bloomington Fire Department, the downturn in the market collapse, and they're the largest volunteer pension in the state, had a significant impact on the city's required contribution, as it did in Eden Prairie, and an additional result is going to probably result in a reexamination of their pension structure and the plan, which then could impact recruitment and retention issues, which are very significant issues in the state of Minnesota when 90% of the firefighters are paid on call or volunteer. And so you're counting on citizens volunteers at the exact time that the demographics are kind of working against you, and now you're going to possibly be recasting how the pension plans work. And so then, do you get enough people to show up to fight fires in your community? in talking this morning with a gentleman, I believe the city was Babbitt, he was telling me that they're down to less than 10 volunteer firefighters to cover that city's firefighter needs in that area, which is a shockingly low number. So I just wanted to bring those things to light and say that, you know, we all read about stuff in the national journals, and we kind of see it in this sort of ethereal way. What happens, maybe some of our own personal pensions get impacted, but I'm not sure that people really understand the potential that this has on our communities, and ultimately the cost to our communities to provide this very basic public service, which is firefighting. It goes back to the beginning of time, essentially. And without citizen volunteers and proper funding, you know, what's the other alternative? It's probably something that's going to be significantly more expensive.
Thank you, Chief. Yeah, you can see that this has a public safety implication in Babbitt and in Wilmer and Cambridge and all the cities you're talking about. This is not uncommon. I'm on health, education, labor, and pensions, and we've been focusing on pensions, and this has happened to pensions, all different kinds of pensions, all over the country. And the question is, you know, when we were more or less flush in the 90s, it was, well, let's lift the requirement, make sure that if a place, you know, some business goes bankrupt, they're 100% funded. Now we're seeing 70% funded, and what do you do then? Do you force an increase in funding at exact time when revenues are down and less people are employed, and for a city like Eden Prairie or Bloomington, you have less of a tax base because Dave Berg is unemployed instead of working and paying taxes? There's just this ripple effect. Ms. Kimball, I want to ask you about the Consumer Financial Protection Board and what you see, what its effect is going to be on your members.
Well, I think it's twofold. One, I think just giving confidence back to consumers that there is an advocate that is within the government that is overseeing the financial industry and ensuring that this type of, that the consumer is represented and that they're protected is exceptionally important. It is an element that has been missing for a very long time, and that is obviously needed given the current conditions. But I think it also remains to be seen as far as how this agency is implemented and what type of authority, how strong the authority is that is finally given to it. So we hope that...
Well, we'll be pretty independent. It's under the Fed, but it has really a funding stream that is guaranteed, and we'll have an independent, the head of the board. It will be pretty independent, and any ruling she makes will be very hard to overturn.
And that's exactly what consumers want, and that is exactly what is outstanding. And we hope that is
Mr. Berg, you got a job. First of all, I've seen so many people in their 50s who are in your situation, and I've been to mortgage or foreclosure fairs and stuff like that, and so many in their 50s. So when you're meeting with your friends who are in your boat, you say you try to be optimistic, but what kind of work do you think are you going to be able to get back into IT?
That's a good question. That's my goal, but you know, being in my 50s, I'm also fighting with people in their 20s who, and since IT is so new, they probably know as well. You know, they can do what I can do. They just haven't been doing it as long, and things change a lot. But one of the groups, you know, the people are just optimistic, and they're saying, you know, you have done this, you can do this, and I don't know, it just kind of ups your spirit. And of course, we're all trying to help each other find something. I mean, you know, maybe somebody doesn't know, you know, somebody might know someone at some company that can help you. So that's kind of the beauty of it. And
we're all hoping.
I mean, and especially being a job seeker in their 50s, networking is so important, and that's what these groups do.
We're all hoping for, I mean, right now we've been told we're in a recovery, but a jobless recovery to me is not a recovery.
Can I just add one little thing?
Yeah.
That, you know, it's still tough, and I know jobs are the last thing to come out of recovery, and
right.
There's still, for every 5 job seekers, there's 1 job, and it would be nice if it was the other way around, like it was in the late 90s.
Well, hopefully you're right. It is sort of a lagging, something that lags, which is our jobs. But to me, there's no such thing as recovery, as a jobless recovery, and we have to be conscious of the need to keep, that we're not out of the woods yet at all. And this is an issue that I'll be dealing with when I go back. Well, I'd just like to close now because we are running out of time. I want to thank all of the witnesses today. I hope today's hearing affords you each an opportunity to, everyone here, to learn about the economic impact on Minnesotans, and about how the Senate reform bill will hopefully end Wall Street's abuses and make sure that taxpayers won't again be on the hook for those abuses. Once this bill is passed, it goes through the House and Senate conference and is passed in both houses. I'm confident that this will create confidence, and hopefully we will come out of this greatest recession since the Great Depression, and we'll start seeing those jobs come back, and we'll start seeing real growth, and we'll start getting back. And we've come out of these things before. We're the United States of America. We have a lot of innovation. We need to do so many things. We need to educate our kids. We need to continue doing research and development. We need to continue building infrastructure. We need to innovate. But I am confident that we're going to do it. So I'm glad that we were able to pass this bill in the Senate, and I look forward to passing it again when it comes out of conference and for the President signing it. And I want to thank you all again, and hope that a year from now we're all going to be rolling in dough. I'm not sure that's going to be happening. Thank you all. Thank you. There.